for Monday, the 8th of of September. I'm trying to make it one day more. I don't know why. It's just the way we're doing it. But here we go. Question to the group. I'm curious to know, hey, what do you think is going to happen What do you think is going to happen for September? Lee, thank you for letting me know. I'll see once again what I can do to make those changes. Which probably means all right. Back to everything. Someone tell me, I'm looking for some comments. What is mods here? Perfect. Give me your short and skinny. What do you think is going to happen in September? And I see very volatile. Obviously, you might have got my my email. Someone tell me what's going to make it very volatile. Pullback in second half of September and October, 100%. Give me how much do you think of a pullback we're going to get from middle of September through October. How much of a pullback do you think we're going to get? That's legit. I think that's probably a good. I would have said somewhere between 5 to 8, 5 to 10 makes perfect sense. Depends on Fed decision. So what is your expectation of the Fed? Depends on the Fed decision. What is your expectation on the Fed? 7%. We got another 7% pullback. Understand that if we do get a 10% pullback, it's my belief that we're going to be down for the year. Taking a quick look. Year to date, we're 10.43. So if we get a 10% pullback, we'll be up less than 0.5% year to date. With Powell kicked out of markets, we'll go crazy for a while. I 100% agree with that one. With Powell, but Powell won't necessarily be kicked out. But we'll just say with Powell kicked out, or with him starting a dot plot rate cutting cycle, the markets could post another 20% plus year. 100% agree with that. That's interesting comments there. And depends on the Fed decision. Everyone thinks it's a 0.05%. I'm going to say possibly 0.5%, but yeah, I probably don't see it either. All right, when you made the comment, very volatile, where's your very volatile explanation? Fed lowers 5 points just to piss off Trump. I agree. I mean, they are behind the curve. Obviously, if you read my recap that I sent out last evening, there are cracks in the economy. Not that it's a worrisome, hey, we're all going to hell in a handbasket, but there are definite cracks in the economy that we need to let me take that back. There are cracks in the economy and in employment and housing in areas that rate cuts should help. And I'll be honest with you, the Fed is not supposed to be political. Let's just go ahead and call it. In fact, if we go very volatile, FOMC is not supposed to be political, but they no, they didn't. They did not raise rates. They cut rates. They cut rates the November before the election of a surprise 50 basis points. When the expectation was a quarter point or wait until after the election, which is what we were saying. They could have very easily said, hey, we're here, we're going to wait till after the election. We don't want to influence the election. And the FOMC is supposed to be standalone. Not only did they cut by a quarter point, they cut by 50 basis points. And at that time, it definitely did not need to be done. Yes, the president is political, but the FOMC chairperson, Federal Open Market Committee, is supposed to be non-political. If you go back and listen to some of my commentaries before the election, we were saying the best thing would be to just wait till after the election, and in December, go ahead and make the cuts. If he's going to make cuts, if he's going to be apolitical. But the FOMC was political. They obviously wanted a Democratic president. Or at least it's, okay, so that's not fair to say either. Or at least it seemed they were willing to influence the election to hopefully make the economy feel like it's in a little bit better shape. And that's what happened. And let's face it, that's primarily what Trump wants. Trump wants Trump wants it to feel like the economy is in a little better shape. Okay. So let's face it, we really don't know if it was going to come down to volatility. My thought process was the volatility would be affected by, or most affected by, some type of problem with the tariffs, right? If we went through a tariff problem, then we have a problem. I did a little fact finding, and how do I say this? Let's just put it this way. Does the president have the right, per the Constitution, etc., does he have the right to make tariffs? And let's call it as what it is. Is it yes or no? It's the executive branch. Ooh, so we have no, it's Congress, which technically speaking is 100% correct. The problem is they haven't been doing it. This is an AI overview. The U.S. Constitution grants Congress the power to regulate commerce through the Commerce Clause, Article 1, Section 8, Clause 3, not the president. However, Congress often delegates some of its tariff and trading authority to the president. In all honesty, when we talk about some or delegation, can someone please tell me when Congress started delegating this power to the president? It's clear as day. Who was the president this power initially was started to be delegated to? Roosevelt. That's a really good guess. That was kind of my guess as well. But that's not necessarily correct. Give me another guess. And Stuart, yeah, I mean, that was my, and I couldn't tell you which Roosevelt. I would have said Teddy, the one in the wheelchair. But no, there's a different one. Someone give me another guess. And this is hilarious. Anyone know? The first, I'm going to call it modern president was a Democrat. Nixon who imposed, and it's funny because he imposed a temporary tariff under the 1971 Trading with the Enemy Act. So here's where I kind of giggle. Thank you, Lee. The first modern president to do it was a Democrat, and the time frame I hope you're wrong there. Damn it. You are right. Well, you Democrats are going to get to pick on me right here. The first modern president was Republican. Dang it. I did not do my research correctly. And it's funny because how long that this power lasted? How long was the trade with the enemy temporarily supposed to be there? Those tariffs were still in place in 2008. So those temporary tariffs were still in place for 39 years. So question comes down to, and I made the comment last week, I don't think it matters. If the Supreme Court was going to do their job correctly, the president has the power to do tariffs up to 15%. That's it. It has to go to Congress. Congress is run right now by both houses. House and Senate are run by Republicans. It's primarily should be, boy, you think I'd have more of my stuff together. It should be a non-issue, but we could have those that want to make a stance, in which case this could be a really big problem. It's not like we would have to pay back all of the tariff money, but boy, that would make a big issue in regards to what portion we would have to pay back or how we'd have to review things. So it'll be interesting to see if the Supreme Court does their job. Yes, President Trump has overstepped his bounds in a big way. Has it been happening for over 50 years? It has. But until they find an act where Congress is given the authority to run tariffs however they please or through executive order, which Trump has not been running through executive order, it is not legal what President Trump has done. It'll be interesting to see how this works out. That is where the volatility is coming from. So with that said, just to give a general overview on where we're at, because in all honesty, let's face it, we don't know any better than anyone else does if we don't know what's going to happen. We don't predict the future. Right now we have Bank of America, $50 law puts in place. We got Google, 210, 220 bull put, and they are the 10th of October. Taking a quick look, Bank of America is also the 10th of October. We have strategy. They were leap short calls. The 18th of January, 2026, and they are $430 short calls. Yes, we took a $175 credit in, and we only got about a third of them filled. We do have NVIDIA, 20th. So I don't know exactly, but we do have 175 puts on for NVIDIA. And that's it. We are attempting to be nimble in our protection and I would say using short calls. Question was asked in the email, Kevin, why short calls? And it's because the bigger credit with the volatility can be erased quickly with Fed rate cuts. So the short answer is we think we'll lose more money quicker with short calls, and we don't want to see that on long puts. So that is why we have very short, how would I say it? We have very few long puts in place, and we are looking for more calls. With that said, I forgot, we do have Palantir 180 short calls, or we are trying to get 180 short calls in play. And our general thought is, hey, let's do the best we can to take advantage of volatility so that we can do the best we can to see if we can take a volatility crush on them with a rate cut that's 95% expected to be in place. So that's the short and the skinny. Okay, big picture. Big picture somewhat echoes what we just said. Payroll growth is limping along, flashing warning lights. The Fed not much longer. Treasury market is pricing in a weaker growth outlook. Labor market isn't broken, but they're cracked. So let's face it, it's not growing in a robust way. Very interesting article. They're being objectively speaking, and basically they're calling for a 50-point rate cut, which could be overdue. I did like their analyst insight. The stock market's initial reaction to the report was rooted in the notion that the Fed will be more aggressive in altering its restrictive monetary policy. But at the same time, its enthusiasm was tempered by a consideration that the Fed is late to this game and that the economic and earnings data will suggest as much in the coming months. Well, it's interesting because the earnings have been quite good. But the earnings are quite good, again, in a segregated area. Retail, some was good, some was bad. Materials don't look good because of tariffs. With that said, there's some material companies based in the U.S. that look really good. It's a hodgepodge of economic reports, of earnings reports, of guidance reports. The one thing we can 100% agree on, though, is that hiring or job growth has weakened and slowed dramatically. The other thing that has weakened and slowed dramatically, consumer confidence. So with that said, again, the Fed is usually late to the game. It shouldn't be a surprise. Hopefully they'll play catch up. Dow Jones Industrial Average, bullish. Bullish, and it's a rather sideways-ish pattern. Last month, we just had the three-step chart pattern. Week and a half, bump up, week and a half, bump up, week and a half, and it's been flat now for about 2.5 weeks. I would not call this we're not building a base here. We're stalling out. This is more of a stalling out pattern than building a base. Yes, we are still technically bullish, but it's a stagnated growth pattern for the last 6 months, even though we are higher. S&P 500 looks a little bit different. But if you take a good look at the S&P 500, we are forming what appears to be a triple top. Definite double top through the month of August. Very little growth, 1.9%. I guess that's 1.9% if you add in the dividend payment, but it's approaching a triple top pattern. Our breakout would have to be the news of a dot pattern, not just a rate cut, but a dot pattern that gives us easing throughout the next year. We have our unusual NASDAQ. Technically speaking, we made a head and shoulders pattern. So for those of you that love technical trading, we made a head and shoulders, or we almost have an inverse head and shoulders, 2.8 or 21.8, 20.7. We're basically back at 21.8. Inverse head and shoulders says we're going to be bouncing higher. Our technicals do not give us a valid picture of where the market is going. If anything, technically speaking, NASDAQ should be going higher. S&P 500 should be going lower with a triple or a quadruple top. And the Dow Jones is undecided. But the Dow Jones shows a typical step-up pattern, which would mean technically a small increase in the next 30 days. Gotta love technical analysis, right? September, we're still going with a negative 2.0. We want to be wrong. It would not surprise me if we get a couple percentage point up bounce due to a Fed cut, and it would not surprise me to see that be taken away with a Supreme Court ruling on tariffs. So those are what we're looking at. Most likely, when I say we're being nimble, we get a bounce up, we're probably going to be protecting everything. We get a rate cut and a 2% bounce higher, we're going to be protecting at that 2% higher position, and we're going to run it all the way through till the end of October. Earnings, we have no earnings other than Chewy and Adobe. I believe we have Kroger on Thursday. We do. Economic reports, rather important for the PPI and the CPI numbers. As long as they're in line or slightly higher or lower, we should be getting a rate cut. How am I looking to trade? We had more protection on a couple of weeks ago, but nimble would be the best word to use here. And again, I say time to start protecting is going to be more clearer after a rate cut slash 2% jump in the market for our historical downturn. Okay, have some interesting articles here. AI is not just ending entry-level jobs, it's ending the typical career pattern. They call it a ladder as we know it. No longer are we starting in the mailroom and working our way to CEO. Those days or entry-level jobs are declining, and they're declining rapidly. I actually don't see it in all areas. I definitely see it in tech companies, but I'll be honest with you, other than the mailroom, I'm not seeing this huge drag on entry-level positions. It might be that I'm just too far removed from being in corporate America. But I found a very interesting article I wanted to share with you on how, yes, AI is currently taking away some entry-level jobs. Will it also take away entry-level jobs in manufacturing areas? Possibly. We've seen it in the automobile industry with the with technology taking over the manual labor or brute force of making cars, but that's been happening in different segments for years. I mean, since the 80s, right? Interesting article, just something for you guys to think about. Warren Buffett's exiting Kraft Heinz. He owns 27%. If you're looking for a bearish opportunity to make some money for your own trading, Kraft Heinz is probably an interesting one to look at. I just moved away from that. Kraft Heinz. Ooh, ugly looking chart, not getting above the 50-day. My thought, if you're looking for a bearish play, Kraft Heinz would be an interesting opportunity for you to be to look at and to try to use for a trade. Go ahead and really, if you're looking at some kind of Kraft Heinz trade, do it, use it. It's going to be an opportunity for you. All right. I can't understand why anyone would be in United Healthcare. Already down 50%. It's 50% off. CEO murdered. CEO Andrew Whitty, the justified investigation for its billing practices. Yet we have two big names. Well, we have three. I guess Buffett, Tepper, and Michael Burry are all looking at getting into a company that fundamentally looks like dog crap. Already down 50%, but apparently it's not going to go out of business, and there's some big opportunities for it to go higher. I don't see it. But this is that one when, hey, cheap valuation. Well, let me put it this way. The last time I saw this type of attitude was on a company with the ticker symbol BS for Bear Stearns. Reason. It's not run well. It's going to have issues and fines. While we believe that UNH shares appear attractively valued on a 3-year plus time horizons, UNH's next 2 years could be very choppy from a membership, reimbursement, and profitability perspective. Well, then, for hell's sakes, get into it 2 years from now. See if it's still going to be around. They're the nation's largest and most powerful insured, United Healthcare. So were banks, and they went under. Don't buy the hype. Don't jump in. Tariffs are killing retail. Not true. By TJ Maxx and the winners, tariff-induced higher prices drive consumers to hunt for value. It's a very interesting article that's telling you those retailers that are working in a tariff-based market. Yes, it's the reason why we got out of Under Armour. And yes, it's the reason why we're getting out of oil. A really interesting article. And I disagree with the title, as it is obviously not 100% correct. But there is a zero capital gains bracket that you can sell stocks for zero tax if your total income is less than $43,000. Actually, they say that a little bit differently. For 2025, you qualify for the zero long-term capital gains rate if your taxable income is $48,350 or less for single filers, or $96,700 or less for married couples filing jointly. Taxable income comes down to after your write-offs. So there will probably be a tax harvesting strategy or use at the end of the year. We will be looking to protect, and as we talk more about our required minimum distributions as they're coming up, there are some of you we're going to look at for the opportunity to get out of some stock positions and increase that step up price cost basic, excuse me, so that we can take advantage if you will fall into these categories. 48,350 of taxable income, 96,700 or less for married couples of taxable income. Taxable income is a line after your deductions. And then on the bad side, I've also got Medicare Part A and B premiums and deductibles. I was going through this as well. They're just charged, and just for you to look at, if you have over $2.5 million in IRAs and Roths, this is something you want to be looking at for seeing where you're going to be at, as well as income for Medicare and Medicaid. I just stuck it in here. I haven't gone through it, but my tax gal pointed this out to me and wanted to make sure that I was made aware of it and that I could pass it on to other individuals. So with that said, any questions you guys have for me today? Are there any questions that I can answer for you guys? And Bill, I think I took a look at something similar to this, but it truly has to be an act or a law for it to be referenced and used by the Supreme Court. So I will highlight that. And I know it's been delegated, but I did not see an act, a legal act or law that was created that allowed that to go into place. I don't know if you maybe showed me that earlier. But I will take a look at it and review it later. All right, any questions from you guys? If there aren't, thank you for being with me tonight. I hope this gives you a general idea of our game plan and the uncertainty. Our thought process is if we get a jump, roughly looking at 2%, if we get a 2% jump in the day or days following a rate cut, we'd like to protect at that higher price point through the end of October. And then we're looking for a Christmas rally that might give us a 20% plus return running into the end of the year on the S&P 500. Yes, I'm trying to stall to see if anyone else comes up with any other questions, but I don't see any. Guys, have a wonderful evening. If a question pops up, I'll answer it, but have a wonderful evening. I appreciate you guys being with me here tonight. Thank you for correcting me on my Republican Democrat. For some reason, I said Democrat, but sometimes I'm just dumb, politically speaking. So do not ever hire me to do your politics. Just hire me to trade your money. All right, guys. Hey, appreciate being here. Thank you for being here tonight. Look forward to seeing you next week. And everyone have a great evening. Bye-bye.